Greg Andruck here with another Business Freedom Conversation post. So folks, this is an enormous story, and it's a minor article in this week's Business Week. Why? Well, you know, the dude that just got, lost being the Speaker of the House, Jim Jordan, well, he was investigating government control of the press. And basically what came out is every agency in the government has been editing or pulling stories at will. And apparently Elon Musk, once he took over X, gave the data to a Wall Street Journal reporter and then a Washington Press reporter, I think. Anyhow, the reason I bring it up at the beginning of this is an enormous story. It's like the canary in the coal mine. This is one that everybody needs to pay attention to now. This is the economists at Bank of America have analyzed the entire history of U.S. bond market. And so what has just happened in the last 2 weeks is the worst performance of the U.S. bond market in 236 years. It's literally the canary in the coal mine. What's driving this? Well, the first part of it is the U.S. massive deficits. They're finally making large effect on the markets. You realize that we're borrowing $2 trillion a year and have for 11 years. We're going into the 12th year where the U.S. budget, this is why those few Republicans, are trying to tighten things down. This isn't sustainable. So the Fed needs to finance debt service by issuing bonds. And of course, the interest rate used to be less than 1%. It's now 5%. So look at that massive increase of what they have to finance as they roll the things over and have this huge interest rate. And what it's doing is that it's overwhelming the buyer side of the bond market. And you have Brazil, who's not a major one, but they're a major player in buying U.S. treasuries. But the largest player, China, Japan, and Saudi Arabia have stopped buying U.S. bonds. And in fact, some of them have started selling them off because of what they see coming in the future. It's a warning to Washington that deficit spending and inflation needs to be reined in. And maybe that deficit spending is impacting that inflation. See my story just a few days ago about the real inflation rate. Look, if the post office has to raise rates 13.3%, it ain't a 3.7% inflation world we're living in. So I would take note of this. So economists predict that Treasury yields above 5% brings on a recession. Well, guess what? Treasury yields are at 4.89%, and today or tomorrow or sometime by the middle of next week could exceed 5% because things are continuing to drop. Why? Because our government is continuing to borrow and spend. So here's another very interesting part of this Bank of America study is rates from 2008 to 2020 were the lowest rates in 5,000 years. Note that, 5,000 years. And that today's rates are, 8% mortgages and 5% savings account yields and all that. They're the real normal. Now, as a business owner, where you got to pay, you can't be like the U.S. government. You got to pay, you got to balance everything. You got to pay your rent. You got to pay your employees. You got to pay for suppliers. And you can't borrow unlimited amounts for an unlimited amount of time. This is the new normal. Note this. The world is changing tremendously. And what the real fear is, and you have to remember, this is a really big point. This is bigger than the savings and loan crisis in the 80s. Savings and loan crisis in the 80s was an extended period, 9 years, of continually raising rates. And because the upward yield, the curve was so long in an upward yield that it never recovered. It never went down, so the value of the bonds went up. That the savings and loans who were buying mortgage-backed bonds, they just kept deteriorating over the 9-year period and wiped out thousands of savings and loans. Well, U.S. banks are sitting on about $2.5 trillion of losses in their portfolios, and that's before the last 2 weeks' losses. So they could be over $3 trillion in losses think we might have a banking crisis if the bonds go down. We already had a mini one that was all covered up and taken care of and like nothing ever happened. But the problem is the rest of the banking system is sitting on these enormous losses, probably now close to $3 trillion. And if your local bank goes away, what do you think happens to the economy? So anyhow, take a look at the story. This is Greg Andrick, Business Freedom Conversation. I'll keep bringing you these interesting ones. This is going to start shaping the conversation over the next couple of months. I'll catch you on the next one.
We have seen this backup in yields and this pain that's coming.
Most of the sell-off is overdone.
Treasury's always been that safe asset, super safe. And it feels like something's cracking.
We're still waiting to see the worst of it. I mean, yes, yields have gone up, and there's plenty of good reasons for that.
We haven't really gotten much by way of new data that would justify, 50 basis points higher in 10-year yields in a very short amount of time.
If you see slowdown, stabilization in the growth trend, the upward trend in yield stop. And if upward trend in yield stops, every other market stabilizes.
As weak data comes out, we're going to see Treasury yields go lower, and then we're going to get back to thinking, okay, what is really the long-term trade? And I think that's probably now higher yields.
We are very bullish on short maturity, high quality investment grade bonds right now.
Valuations are attractive here. This is a good entry point for yield investors.